Welcome to this episode of Hardman Talks. I'm Larissa Adams from Hardman & Co, and I'm glad to be joined by Doug Lawson, co-founder and CEO of MarktoMarket. Doug, hi, thanks for coming onto our channel.
Thank you for having me.
So I'm excited to get right in and talk about M&A trends and hot topics for 2021. But before we dive into that, let's just take a quick step back for a second for those not familiar with MarktoMarket. So in essence, this is an exciting game changer of a platform and data provider, and it helps corporates, advisory firms, and institutional investors research, identify, and value private companies to facilitate transactions in the private capital markets. And it does this by coherently presenting data and information on private companies that would have otherwise been very difficult, if not impossible, to find and put together. So Doug, in a past life, you were on the buy side as an investment manager, and you were in the hot seat, so to speak, making investment decisions and needing the solution that you're providing to fund managers now. So maybe just tell us a little bit more about yourself and that decision to go from investment manager to founding your own fintech startup.
Yeah, sure. So I spent my career in finance, as you say, and I up until the point that I started MarktoMarket. And I went through a reasonably conventional route. I started doing my chartered accountancy training. I moved into corporate finance. I moved into private equity. And then I ultimately ended up working in quoted company fund management. And I would say that having worked in the private company arena and the public company arena, and having used all the data tools that are available, I was struck by the asymmetry of information that was available on public companies relative to private companies. And that's not really a huge surprise to anybody, and it's really by design. You know, private companies don't have the disclosure requirements of public companies, but there is a lot of information out there about private companies. The trouble is it's not easy to find, and it's not elegantly structured in the same way that intelligence on public companies is nicely pulled together. So what that means is to build up a picture of a private company and how it might be performing at any point in time, you need to stitch together information from multiple different sources and clean that information up and make it searchable in an intuitive way. So I knew from my experience of working in finance as an investor and an advisor that there was a problem there with accessing private company information. And then at the same time, as an investor, I loved software companies. I loved the characteristics of software companies, namely recurring revenues. And I also love data companies. So data companies tend to have very strong barriers to entry. So I sort of promised myself that if I felt I could solve a problem that I really understood, and I felt this was a problem that I really understood, and solving that problem involved software and data, then I would start a business to do that. And I got together with somebody who I knew could help with that, and we founded MarktoMarket.
So as a business, how would you say MarktoMarket differentiates itself compared to other data as a subscription services like PitchBook or Bohurst? How would you go about that?
Yeah, sure. So there are other data sources out there, and you've mentioned two of them that I think are very good. I think we differentiate ourselves on three fronts. So first of all, we're whole of market. So we don't just focus on growth companies or companies that have been involved in a transaction, although we have information on all of those businesses. There are hundreds of thousands of companies out there that are interesting to specific advisors or specific investors that may not be on the radar of the other platforms because they're not displaying specific characteristics. So we kind of ignore whether the company's been involved in a deal or not. We, in terms of whether it gets inclusion on our platform or not, we ignore whether it's been involved in a deal. We ignore whether it's displaying specific growth characteristics. We just include everything. So we've got the whole of market. So that's the first thing. I think the second thing is that we stitch together data from traditional sources. So the classic traditional source would be Companies House. So Companies House filings. And that information is all very useful, but it's very backwards looking. So if you really want to understand what a private company is doing at the moment, you need to gather information from what we call alternative data sources. And that could be anything. That could be alternative data sources are just any source that is not traditional. So it could be news, reviews, jobs, employment, anything that's kind of up to date that helps you to build up a picture of how a company is doing at the moment. And that's pretty difficult to do. It's quite difficult to stitch information together on companies that is coming from multiple different sources, but that's a key engineering challenge that we think we've overcome. So that's the second thing. We take data from lots and lots of different sources and create our own data sets, and we stitch all of that together. And then the third thing I think is our data veracity. So a lot of our data can be audited back to the source. And what that means is that users can see where a specific data point has come from, where it's been collected from, and they can judge the legitimacy of that data point based on its source. So I would say those are three key differentiators: whole of market coverage, information from multiple different sources, both traditional and alternative, and then a high degree of data veracity.
Yeah, and I could imagine that is such a time saver for your users, because collecting data from all those different sources, making sure that it's legitimate, I can imagine that is incredibly useful to have that sort of breadth. Brilliant. Okay, so let's look at M&A a little bit more broadly. It's very clear that M&A activity is accelerating, which is obviously, it deepens the need for a platform like MarktoMarket. Now, there's data from MarktoMarket that actually shows that UK M&A deal volume started to recover in the second half of last year, and it's now surging higher than deal volume pre-lockdown. So what do you think is driving this? And do you think these volumes are sustainable?
Yeah, so you're right in that last year, deal volumes fell off a cliff in April. So April 2020, we saw a very sudden and rapid decline in the number of deal completions. And I think the reason for that is pretty obvious. We were, COVID took hold and people felt they couldn't do deals or they didn't want to do deals. Vendors really retrenched from the market. If you didn't have to sell at that point in time, then you probably were inclined not to. So deal volumes fell off very sharply, and that kind of continued throughout the summer of last year. What we found in the second coming into sort of the end of Q3 and Q4 of 2020, volumes started to recover, and they recovered pretty quickly. And then we saw extraordinary levels of deal completions in the first quarter of 2021. So what was happening there, of course, was that people were coming back into the market last year as people became more comfortable with doing business over Zoom, doing deals over Zoom. So transactions that were probably put on ice in April, May, June of last year came back and were being completed in the latter half of 2020. So that was the first thing that caused this kind of snap back in the volume of deals. And the second thing was the fact there was an anticipated change in capital gains tax. And one of the changes which was mooted was a change to entrepreneurs relief. And so you had a lot of vendors, a lot of founders of businesses wanting to complete deals before those changes were announced and became effective. And that drove a real surge in deal volumes in the first quarter of last year. And actually, those changes did not happen, but because they were anticipated, there was an urgency to getting deals done. So we saw very, very high volumes in Q1 of this year. Since Q1, the second quarter of this year, and we're now into the third quarter, I would say volumes have normalized, but normalized at kind of the high end of the range. So we're seeing still pretty reasonably elevated levels of deal volumes. And certainly speaking to our customers, they're telling us that their pipelines are really healthy at the moment. And I think that, there are lots of reasons we could come up with for that. I think the one that's often quoted is just the sheer volume of private equity, what the industry calls dry powder, that's capital waiting to be invested, that is out there. And the figure that's banded around a lot is $1 trillion. So you've got $1 trillion of global dry powder waiting to be invested. And inevitably, with all that capital out there to deploy in funds that typically have a 10-year life, that money has to be spent. So that's going to continue to drive elevated volumes of transactions, we think.
And where are we seeing this activity, or where are we going to see it? Because there's certain industries that you would be earmarking as hot sectors, ripe for consolidation and M&A activity. So where would you place the needle?
Yeah, so I think what we're seeing is we're seeing a lot of activity in what what you might call COVID survivors. So any businesses that proved resilient throughout 2020 are seeing, any businesses like that are highly sought after by investors. And the attitude, of course, is if you can make it through, if you can prosper in an environment like 2020, or certainly from April onwards, then you can probably make it through anything and prosper in any circumstances. And you could cite specific sectors, but equally you could cite specific business models. So, for example, anything with a subscription-based model would be expected to perform well in that environment, because you've got underlying subscription income, it's probably contractual, that's recurring revenue, and that will see you through a period of short-term volatility or weak demand. And those were the first assets, kind of businesses with subscription-based revenues were the first assets to see price inflation or multiple expansion, some people say, as investors recognized that they were probably a nice safe haven against that volatility. So if you're going to have to invest in something, go for businesses with that kind of stability and that level of revenue visibility. And the other area, so you've got subscription-based businesses where we saw lots of activity, and then the other area was any digital business. So, or digital businesses in general. So, you could say, just coming back to my comment about calling out specific sectors, you could say that retail had a tough time. And if you're looking at bricks and mortar retail, that's absolutely correct. You had enforced store closures, but then online retail was absolutely flying. And it was an opportunity for the online retailers to pick up traditional bricks and mortar retailers at distressed pricing, with a view to changing their business model to online. So I would say lots of activity in digital or digital enabled businesses, including e-commerce, and lots of activity in businesses with subscription revenue models.
It's interesting what you're saying about subscription model, because it's an easy rollout, and it ties in tech. So anything that you can sort of sign people up over a computer, or it's a very easy model to get people on board. Exactly. So I can understand that. So what are the key themes that you're seeing in M&A, and where do you see things going for the rest of this year?
So we're seeing lots of buy and build, and buy and build, as most of the viewers probably know, is where a private equity business buys a platform asset and then uses that platform to acquire a number of smaller businesses. And typically you'll pay a lower multiple for the smaller businesses than you will for the platform. So by buying these smaller companies and bolting them onto your platform, you benefit from multiple arbitrage. We're seeing a lot of that at the moment, and it's been popular in some specific sectors. So, for example, vet practices. If you look at who has been completing the most deals M&A transactions in the UK over the last 5 years, 2 of the top 3 buyers are vet consolidators. So vets has been a big one. IFAs and wealth managers has been another one. Estate agents has been popular for this. And then some compliance related businesses like, for example, fire compliance services, fire safety providers. And we don't really see that slowing down. I think that as long as there are opportunities in those sectors, in those specific markets, that consolidation will continue. When those plays have exhausted themselves, the market will move on to new areas that look ripe for consolidation, and that'll start happening again.
So bringing the conversation back to MarktoMarket, can you give our viewers a sense of what type of data you're providing on private companies? So in other words, when you're onboarding new clients, what is their number one need from the platform?
Yeah, sure. So I would say that in terms of the needs that our users have, there are maybe 3 things that users are looking for when we're onboarding them onto the platform. I think the first thing they're looking for is an origination tool that allows them to identify the right businesses. And those could be, if it's a private equity customer, those are the businesses that they want to invest in. If it's a corporate finance customer, those are the businesses that they want to advise. So it's identifying under the radar companies in an efficient way. That's the first thing that customers always want to do. The second thing I think is on the valuation side. So there's a key need for reliable transaction data. So when we're onboarding customers, they want to know, okay, how do I build a set of recent transactions that is relevant to me? And how do I see the underlying data and trust the multiples that you have on the platform? That's a second thing. And then I would say the third thing is maybe a bit more on the execution side. It's questions like, who is going to buy my client, or who is going to buy my portfolio company? Who's active in the market? What are they paying? Do they have the balance sheet strength or the borrowing capacity to do it? What private equity players are active in this market? That's kind of a key need for our customers, is to understand all of that information. So that's kind of 3 examples of the types of information that we can provide to help our customers do their job.
Yeah, makes sense. Okay, so lastly, what's next for MarktoMarket? Where do you see the company growing and building out further?
Yeah, so I think I hope we're building a reputation as being a trusted provider for data on the private capital markets. And I think that what we want to do is continue to build on that reputation and to be the go-to place for gathering intelligence and for making markets in private companies. So allowing participants to come together and execute transactions, that's what we want to facilitate. And we do that through information and through data.
Wonderful. Okay, thank you so much for your answers, Doug. It's been an absolute pleasure chatting to you.
Thank you very much for having me.
And to our viewers, please don't forget to like and subscribe to our channel. We appreciate your time. If you've got any thoughts on what we've been discussing here today, don't forget to leave your comments below and hit that like button. Otherwise, we will see you back here on Hardman Talks next time. Thank you.